It's another edition of Business Morning. Good morning and welcome to the program. I'm Chimeze Obi Iwagu.
And I'm Ladi Williams. It's great to have you this morning. Let's look at what's in the news. The Monetary Policy Committee of the Central Bank today began its rate-setting meeting, the fifth for the year. This committee will consider both domestic and external factors in coming up with its decisions on policy for the next 2 months. At its last meeting in July, the committee retained the monetary policy rate at 11.5%. It also retained the cash reserve ratio and liquidity ratio at 27.5% and 30% respectively.
Despite the declining trend on the inflation numbers, most analysts believe the MPC will still leave rates unchanged at this meeting. The Central Bank Governor, Mr. Godwin Emefiele, will brief on the outcome tomorrow at 2 p.m. Join us by 1:30 p.m. here on Channels Television for the live broadcasts.
And Nigeria's total public debt stock has risen from 33.11 trillion naira as of March 31st, 2021 to 35.47 trillion naira as of June 30th, 2021. This shows an increase of 2.36 trillion, or about 7.13% increase within the 3-month period. Director General of the Debt Management Office, Patience Nia, who provided a breakdown of the public debt stock for the second quarter of 2021, said the total external debt stock rose from 12.47 trillion naira as of March 31st to 13.71 trillion naira as of June 30th.
The total domestic debt stock rose from 20.64 trillion naira as of March 31 to 21.75 trillion naira as of June 30. At the end of the second quarter 2021, external debt stock made up of 38.66%, while domestic debt stock made up 61.34% of the total public debt stock. The debt to gross domestic product ratio rose from 21.13% to 21.92% within the second quarter.
And despite the rising debt profile, President Muhammadu Buhari is writing to the National Assembly seeking approval to borrow the sum of $4 billion and 710 million euros. The president explained that owing to emerging needs, there is need to raise more funds for some critical projects. What is the implication of this for economic growth? We'll discuss this and other issues bothering on the economy with Damilare Ashimiu, senior analyst with AfriInvest West Africa. That's after the break. Do stay with us. This is Business Morning.
Well, Damilare Ashimiu, senior analyst with AfriInvest West Africa, joins us now. Good morning, Damilare. Thank you very much for joining us. We see that Nigeria's total public debt stock has continued to rise, now above 35 trillion naira. Is it time to be really worried?
Thank you very much, Mizzy. Thanks for having me on this show. Well, I would like to start by saying that the new debt number is actually, we saw it coming, given the fact that in the 2021 budget that was assented at the beginning of the year, the FG already mapped out that they will be borrowing 2.3 trillion from the domestic markets and 2.3 trillion from the external markets. So with the borrowings in H1, that was what was able to move up that debt profile to 35.5 that we're having now. But equally concerned is the fact that now Nigeria will be approaching the external debt market next month to raise 3 billion euro bond. And also the federal government just sent a letter to the National Assembly to approve some fresh borrowings, which actually from my own estimate, we believe is part of the 6.2 billion that was already budgeted for, because as at the time the budget was made early this year, the official exchange rate that was used for that estimation was 381. So if you put external debt of 6.2 billion using the official exchange rate at the beginning of the year, you actually get 3.2 trillion. But as of now, that we are going to the Eurobond market as well as this new fresh borrowing, exchange rate has weakened. So with your current exchange rate of 411.50 kobo, as well as naira to euro that has weakened to about 490, the value of the new debt we are likely to get is about 3.2 trillion. So that's almost 1 trillion higher than the nominal value. I mean, the value we actually budgeted for. You may see it as, being a good thing for the government in terms of they now have more, they will get more from those borrowing. But the implication is very wide. It then means that by the time we may want to start repaying these debts, we have to churn out more naira or source for more dollars to repay it. And I'll paint a scenario. Last year, we spent 83% of our revenue servicing budget as full year. And in the first 5 months of this year, Nigeria spent 97% because the revenue realized in the first 5 months was 1.87 trillion, and we'll spend 1.8 trillion servicing debt. So it then means by the time we take these new borrowings, it's possible that our debt service to revenue may surpass 100. And it's concerning because it then means our debt sustainability is at risk. Because what does debt sustainability mean? It means you can conveniently service your debt without recourse to taking another debt. So servicing debt. But the moment the cost of your debt service is higher than your revenue, you are likely to be compelled to borrow another debt to service the existing debt. So which is a worrisome case. And I mean, the country needs to rethink its strategy on taking off debts.
Okay, Damilare, is there a risk of getting into some kind of debt trap here?
Well, it depends on how we want to look at it. In the short term, we may say maybe we don't have a debt trap concern, because if you look at the DMO debt sustainability benchmark, our maximum threshold for debt has been raised to 40% of GDP. So you may want to say that now our debt to GDP is still around 27-28%. We are still comfortable. But if you look at it in terms of our ability to service the debts, I think we're already near a debt trap if we are not there. Because if you are turning 97% of your revenue to service debt, it then means what you only have left to meet your non-debt recurrent as well as your capital expenditure is just 3%. And you and I know that 3% revenue is not even enough to cater for the need. I mean, 3% of government revenue is not even enough to cater for the need of the National Assembly alone, not to talk of the whole nation. If we use 2020 revenue figure as an example, the government realized about 3.9 trillion. So 10% of that is about 339 billion. So, and the amount that National Assemblies, spend every year in terms of their budget is more than that. So what I'm just saying there is that in the long, I mean, looking at the big picture of debt to GDP, you may want to say maybe we are not in a mess yet. But if you are looking at it from the perspective of liquidity, which should be the most important thing, right? We are in serious mess, and I think the government just have to be very cautious of taking them. Now, there's another criteria we don't consider in this part of the world, which is called debt carrying capacity. Now, Japan's debt GDP is over 75%. Now, nobody will shout that Japan's debt is more than twice of their GDP, because even the international borrowers that knows that the pace at which the country is raising revenue is strong enough to make it sustainable. To make the country to be able to pay its debt on a sustainable basis. But look, putting Nigeria in that shoe, between 2015 and 2019, Nigerian debt in naira term rose about 2.4 times, but in dollar times, almost five times. And over that period, revenue marginally grew about 1.3%. So, and the gap between our revenue and even the debt is so wide, because as of end of last year, our debt was 30 trillion, now it's 35.5 trillion, and only made revenue of 3.9 trillion last. Federal government share of the debt is about 29 trillion, and federal government is making 3.9. So it calls for concern, and it's not really painting a very good picture for the future of the country.
Now, some analysts, of course, will say that it's not a bad thing actually to borrow, but what's important is what you use the money you borrow to do. And the government, of course, justifying this borrowing spree is saying, look, we are channeling it into infrastructure development. So do you think this new debt request by the president is really justified?
Well, if you look at the composition of the budget from the beginning of the year, it's actually a budget that already make provision for for large borrowing. The budget for this year initially was 13.8 trillion. Later in July, the National Assembly passed a sub-budget of about 92 billion, which brings the total year to about 14.8 trillion. Now, the government initially benchmark its revenue for this year to be 7.99 trillion, which are about a deficit of 0.8 trillion. But if you look at revenue performance, at least in the first half of this year, the prorated amount is about 3.9 trillion, but we only got 2.3 trillion. So the provision in the budget has already created room for borrowing, because there are some funding that must necessarily be met. We have to service our debt. We cannot default. And our debt servicing, the budgeted debt servicing for this year is already in excess of 2 trillion. So we must meet that. Also, recurrent expenditure for this year plus the supplementary budget is in excess of 5 trillion. Those ones must be met. There is no way. So even if government exhibits some slack in terms of capital expenditure, which is the part that normally suffers anyway when revenue underperforms, the other segment, the debt servicing and the recurrent, will compel the government to borrow. And so I would say, looking from the reality of what we have in the budget, I would say that yes, the borrowing cannot be avoided, because government needs to balance every segment of the budget, from the recurrent to the capital to the debt servicing. But where we feel government needs to be more cautious or be more responsive is in terms of using those borrowing, using it to facilitate generating expenditures. And that's where capital expenditure comes to play. Yes, in the last 5 years, the current administration has borrowed in excess of 5 trillion. But again, it's hard to really spot the effect of many of this borrowing on the economy. Yes, we have some real project going on, but that's not how we need. We need so more. We need power so that the borrowings and to productive things that can repay itself.
Right, but looking at all of this, what is the implication for the credit rating of Nigeria?
Well, so let's look at the debt mix first. In the medium-term expenditure framework, the government itself planned to keep domestic borrowing at maximum of 70%. 70%, and foreign borrowing to be not more than 10%, so as to sustainably meet its debt obligation. Because foreign debt, especially for a country that its currency is vulnerable, easily multiply, because the value of our debt wouldn't have been as big as the 35 we're having now, if not for the fact that the foreign debt there has been revalued, I'm sure. So what this means on our credit rating is the fact that we now have our ability to service debt, or what I would call debt to revenue metric, being more weak. Because if as at 5 months of this year, we're already using 97% of our revenue to service debt, with this new borrowing, it will go up. And so these are some of the considerations that rating agencies will look at, because they will look at how liquid you are in terms of ability to meet your debt obligation, as well as look at how solvent you are. On the solvency side, which looks in terms of debt to GDP, we are still below the threshold that can raise concern. I mean, we belong to the low income earning country, and the IMF benchmark is 35. But the same IMF classified Nigeria as low debt taking, a country with low capacity to take debt, because our revenue is not increasing at the pace at which our debt is increasing. So it is a major concern, and it will affect our rating going forward, because our revenue is not growing at the same pace at which our debt is growing.
Oh, now let's talk about this credit rating, bringing it down, to the state. For instance, recently we had the global rating agency Fitch upgrading the national long-term rating of Lagos to AAA from AA+ with a stable outlook. Now, the rating agency also affirmed Lagos State's long-term foreign and local currency issuer default ratings at B with stable outlook, and short-term foreign currency IDR at B. So what does this mean for Lagos debt status?
Well, it just shows that Lagos have the capacity, right, to conveniently service its debt. Now, let me use last year as an example. Lagos revenue last year was about 543 billion. And if you look at current Lagos total debt to that revenue size, the debt is just about 3% above that revenue. So it means if Lagos was to repay all its debt today, even 2019 revenue is generated, it will only come short of the total debt just by 3%. But if you compare Lagos to Nigeria, it's a different thing entirely. Debt is, at least federal government debt, is 29 trillion now. Revenue is just 3 trillion. So that's several percentage. So what I'm saying is that the improvement or the upgrading of Lagos credit rating is just a reflection of the liquidity state of the state, and the ability of the state to generate revenue. And interesting to know is that about 70% of Lagos revenue, the 540 something generated last year, was from internally generated revenue. It was only the leftover about 29% or so that came from FAC. So it means that credit rating agency have identified this, and these are some of the things they normally consider, which in line with looking at what the debt of the state is being used for. So I think it's a welcome development, and it's a boost for Lagos. And I tell you, it will make it easy for Lagos to raise quality debt at cheaper prices to even improve its economic welfare going forward.
Well, what do you think other federating states should do to improve their IGR and become more viable to investors?
Yeah, so one of the few things that is going for Lagos is the fact that Lagos house more than 40% of all the companies in Nigeria. And you may want to attribute that to the fact that Lagos is Nigeria's most viable entry point to the world. The seaports in Lagos are the most busy. So last time I checked, the Apapa port and Tinker port accounted for more than 90% of all movement in the state. And also Lagos used to be the seat of power until 1991. Infrastructure is there. So it has attracted a lot of companies here, a lot of businesses. So what other states of the Federation needs to do to be able to move up from this level? Because I can comfortably tell you that we have more than 28 states that depend solely on IGR to run. If IGR if FAC allocation, to IGR is like 80 to 20. Such a state is not viable, because if anything should happen to IGR, just like the NNPC did not remit in April and May, the state will collapse. So what other states need to do is first identify their strong point. What is that strong point? What does your state have to leverage on? If it is land, then come up with policies that will attract a lot of mechanized farming into your state. You can make a lot from it. A lot of agricultural commodities has been highly demanded in the international market. So you create that environment, you identify your strength, and you leverage it. So the strength of Lagos is infrastructure, is the seaport, as well as having a lot of companies headquartered here, and they are leveraging it, because more than 45% of Lagos revenue is from paying. So other states should just identify their strong point. What is that resources they have that can deliver better for them at cheaper cost and attract businesses? And the revenue, the IGR, will grow over time.
Okay, thank you very much for sharing your thought with us, Damilare Ashimiyu, Senior Analyst with AfriInvest West Africa. Thanks for your time. Okay, Commodities Market Update is next after the break.
Welcome back. Now for Commodities Market Update. All prices slipped in early trade but kept most of the previous day's gains after a larger than expected drawdown in crude oil stocks in the United States, the world's largest oil consumer. Brent crude fell 13 cents to $75.33 a barrel after settling up 2.5% the previous day. U.S. West Texas Intermediate crude futures slipped 12 cents to $72.49 a barrel after settling 3.1% high on Wednesday. The Energy Information Administration also said that U.S. crude oil and fuel stockpiles dropped sharply last week as refiners in the U.S. Gulf region and oil facilities offshore were still recovering from Hurricane Ida. More updates and developments in the commodities space. Now we have Dumebi, a research analyst with Financial Derivatives Company, joining us now. Good morning. Great to have you.
Good morning. Good morning. Good morning.
Yeah, so we've seen the inflation rate taper, but it was quite higher than your prediction.
Yes.
FBC prediction.
Yeah.
What do you think attributed to this decline at this point? And is it, is it realistic with what's happening in the markets out there?
Okay, so let's start with the numbers before looking at what's happening with the market and whether these numbers are in correlation.
Right.
So the numbers are clearly saying that food prices are still rising, but at a slower pace compared to the previous month. Now, when we look at the numbers, we see that headline inflation declined, food inflation declined, core inflation declined, but month-on-month inflation increased. And that's pointing to something that inflation risks are still elevated, meaning that yes, this is happening now, but there is the high likelihood that inflation will rise again. So even if it's declining now, some of the reasons why it declined was due to the harvest season. You know, some commodities, their prices had started declining in the market. We also started seeing, for example, plantain. We're seeing plantain now compared to last time. There's new yam. There's a little bit of more pepper in the market, even though now there are different species that we're seeing. Onions is available. So we saw that there's just a marginal decline in the prices of some of these commodities in the market. But when we see the month-on-month inflation increasing, it's pointing us to the fact that inflation risks are still very elevated, and there's so many things affecting inflation. What are the risks that we're even looking at that are very evident right now? The number one on the list right now is the exchange rate.
Right.
Is the exchange rate affecting imported inflation? So we're seeing that the price of commodities like flour, pasta, is increasing at a very, very fast pace. So this is going to have a ripple effect. For example, we look at the price of flour, and the price of flour right now per bag is almost 20,000, if not more. And that is going to, definitely feed into the price of pastries like bread and all. And even if the producers of these commodities don't increase the prices immediately, what we're going to see is they will miniaturize the product. So you have bread that used to go for about 150. They will still probably sell it for 150, but it will be smaller. They'll probably pump some air in the bag, let it look a bit big. So that's what we're going to likely see. Another factor is insecurity. There's still so much insecurity affecting the production of food, agricultural commodities, and this is going to continue to have a ripple effect in the commodities market. Then we look at whether this is happening. We look at the reality of these numbers and what's happening in the market. There's clearly a divergence. People are not feeling the impact of lower inflation on their pockets. They still go to the market. That 10,000 naira that will probably buy you a kilo of chicken, 1,000 naira worth of tomatoes that you can cook a pot of stew. You're not feeling it. You want to cook a pot of stew. By the time you look at the quantity of tomatoes, everything is way below what you used to. Some people now you have to buy water. Even water now is expensive. So people are not feeling the impact of lower inflation. That's just to tell you that everything that is happening the consumer is going to continue to feel the burden of all of this. Consumer is going to continue to feel the heat. Why? Because your income is not increasing. If income was increasing commensurate to the level of inflation, people will say, okay, inflation is increasing, but at least my boss is increasing my salary. But you know, that is not happening.
And we have December, you know, coming
exactly.
up.
The Ember months are coming. We're already in the Ember months. Festive period is very much around the corner, and
so we can expect another.
Okay, now looking at what the reality out there and the figures we are seeing, and then that brings us to the fact that, I mean, when we look at the global trend,
yes,
I mean, we have seen that food inflation globally seem to be rising, and then here we are having food inflation coming down. So one would wonder where the consistency is between the global trend and Nigeria.
Actually, when we look at like the UK, the US, China, we notice that in the past few months, their inflation actually declined. So when we look at that with Nigeria's inflation, we could say, okay, it's probably following the global trend. But within the month of September, we've seen that global commodity prices have continued to rise again, and several countries are trying to hedge against inflation. Now, China, India, they've gone ahead to what they've gone ahead to do now is sell some oil from their strategic reserves to hedge against higher commodity prices in their country. And because what they're doing is they are buying some of these other commodities at a very expensive rate. If they have oil and they could sell it off to reduce the impact of this on other prices in their economy, they will do it. So everyone is trying to hedge against rising inflation right now. And the big question is, what is Nigeria doing to hedge against rising inflation? Because even if inflation is falling, when we look at it on nominal terms, it's still growth retarding. The CBN said any inflation level above 12% is growth retarding. And we're clearly seeing that in the economy. Not only that, inflation is still, above the CBN's target, ceiling of 9%. So with everything that we're seeing, yes, inflation is falling, but when we look at it compared to what is supposed to be, there is the fact that inflation is still very much going to continue to hurt the economy. Not only that, we're looking at the impact of that on the consumer, because numbers are there, but when we look at the impact of these numbers on people, that's where we can really tell as economists that, oh, this is clearly having a huge impact. So those are the dynamics that we're looking at right now.
And also we have another issue of the Naira getting weaker. So
exactly.
What impact can we also see from that?
Basically, the simple thing that what's happening in the Naira is going to do is, when we look at this in terms of commodities now, it's going to continue to increase imported inflation. There are quite a number of commodities that are still imported, and we use that almost every day here in the country. And if these prices continue to rise, it will continue to taper consumer disposable income. Consumers will continue to feel the heat. And remember that what is happening with the average Nigerian is not just high food prices. We're looking at higher energy costs as well. They're paying more for electricity. Possibly we'll soon start paying more for fuel in a few months' time. So by the time you look at, and it's not like there are higher rents now. Rent is also increasing because now landlords have gotten wise enough to factor in the fact that inflation is high, and they are revisiting their rents and revising it upwards. So there's so many things hitting the pockets of the average Nigerian. So with everything that's going on with the Naira, clearly that's going to continue to affect imported inflation, and continue to taper consumer disposable income, to feed into the price of some commodities. And this is also going to affect investor confidence. The fact that the Naira, the CBN has not been able to keep the Naira from running away, at this point in time, it's continuing to hurt investor sentiment and investor confidence. And what we need right now is more investment. We need more forex to keep the Naira stable. And if the people that are going to give us the forex are trying to play it safe right now, that's just fingers crossed.
But one good thing about a weaker currency is it's supposed to encourage exports.
Yes,
but we don't really have much we're exporting.
We should be looking at exporting more at this time.
Yeah, but there is still the lag effect. even if we say we want to start exporting almost everything we can export now, there are lots of other factors to look at. How are we, what do we have in place? What do we have structurally in place? What do we have in terms of infrastructure to actually boost production for these commodities that we can export? And another question, who is going to buy it from us? Because people that we're going to sell to already have their suppliers. So what are you bringing to the market that they're going to accept? What new thing are you going to bring to the market? And you know, we have to do more in terms of value chain. You can't just bring a raw material that someone, by the time they get the seedling, they can probably do some, you know, technological magic to get it done where they are. So what new thing are you bringing into the market? What we just saw recent that Ivory Coast, who exports rubber, is they're going to add value chain to that particular commodity. They're going to get some refined products to sell side by side with the raw material itself. So if Nigeria wants to venture, if we want to do that, because we have rubber, we have yams, so what are we going to do that's going to be new? That when these countries say, oh no, I want Nigeria's own.
There's competition there already.
Because there's competition. Everybody is doing a lot more. The pandemic exposed a lot of loopholes for a lot of countries, especially developing economies, especially African countries, especially countries in sub-Saharan Africa. So everybody is, you know, on edge to make sure that they have competitive advantage, whatever thing that they're doing. How can they also attract investment into their economy? South Africa is doing a lot. We've seen that Ford is now in South Africa. Twitter is setting up headquarters in Ghana. What are we doing? What are we bringing to the table to encourage new investment? Because once there's insecurity, no matter what you say, no matter how well you say what you say, if the economy is not stable enough, investors will shy away from coming to it because there are a lot of risks that they have to put in place. And even if they do, even if they want to invest, they will invest and the interest rate accrued to that investment will be very high because they have to make their money back.
Right.
So there are lots of factors to look at when we're talking about exports and all. What are we putting in place to make sure that whatever thing we're exporting is good enough, is competitive in the global space.
Right. Now, even now, we have seen the federal government talking about borrowing more, you know, for infrastructure development, they say, and then we just got the debt stock data still rising. So how much of impact do you think this is also going to have? I mean, we're talking about improving our value chain there. I mean, are we ready to actually channel these funds towards improving this value chain so we can export more and perhaps make more money?
Make more money.
I mean, when we look at debt, the debt profile in Nigeria, we're looking at debt service costs. We're also looking at what this money is being used for. The most important thing is when we get this money, we use it for what we say we use it for, because capital expenditure is one of the most important things to do right now for us to improve output and in turn, you know, boost productivity for the entire economy, get more revenue. Because even if we decide to keep borrowing, we're just, you know, pushing the economy to for lack of better words, to a dark hole, to the black hole.
Digging a deeper hole.
Exactly.
Right.
So it's important that if we're borrowing more money, in its sense, it's not bad to borrow. But what if you're borrowing money, you have to invest it in things that would increase your revenue. You have to be able to pay that debt back and pay the interest back and still have enough to support your economy.
Right.
Now, having the debt profile that we already have, we borrowed some of this debt some years ago. We borrowed some of this money rather some years ago. We're still borrowing some now. In the global economy, interest rates will begin to rise pretty soon. And by the time global interest rates begin to rise, it means that we're going to be paying more. And remember, our currency is already weaker. So that is a double whammy for repaying this debt. Now, we also look at the impact of that on the Nigerian economy. There was a conversation I was having earlier. Almost every Nigerian, if they are to, you know, the current debt that we have, if every individual was supposed to pay from their pocket, it's about 200,000 naira. How many Nigerians can comfortably pay that 200,000 naira?
Right.
You know, and clearly, he just emphasizes the point that we need to do a lot more in terms of revenue generation. So there has to be a lot more to be done. We've had this talk
the
of
government needs to think out of the box.
Out of the box. We've had the conversation about diversifying our revenue base for as long as I can remember, you know. But now it has become more imperative to do that. I keep referring to 2020 because 2020 did expose a lot of loopholes in several economies, and for Nigeria, it deepened the fact that we have to diversify our revenue base. The time to do that has come. We can't avoid it anymore. We must do it. We must do it.
If not, we'll continue to go round and round.
Yes.
Thank you very much, Dumebi. We appreciate your time. Thank you. Okay, we take a moment. We'll be back.
All right, now let's look at what happened in market yesterday with Anyete. Anyete, how's it going?
Yes, good morning, Ladi.
Morning.
Let me say it's getting better for the markets. Although it's not something that you can be too much happy about, because yesterday the market would have gone in the red, but MTN was the major, MTN saved the market. That of course is the market's #2 most capitalized equity, at the NGX. Now take a look at what the market turned out at the close of midweek trading session. 0.12%, which is the highest it has climbed so far this week. On Tuesday, the market was up by 0.01%, which represents about 3 billion naira in value. And then, of course, yesterday we had an increase of 25 billion naira in value. And then, of course, when you take a look at the index, it's slowly crawling its way back to the 40,000 level, 40,000 points level. So we're looking out for whether the market will be able to sustain the uptrend, which is started on Tuesday. Of course, the better part of the month is still at 0.6% in the negative, and then year to date we're 3.2% down. So we're still looking out for whether the market will be able to climb back to into the bear territory so far. Now, like I mentioned, the market was not too impressive in terms of sectoral performance. Take a look at it. Red dominates, while the unchanged here, that green color that you see there, shows that not much of activity was done there. While in terms of volume, we were up we actually fell by 36.8%. Now, to give us an overview of what happened yesterday and then what to look out for in Thursday's trading session, let's talk to Richard Akimolodu, who is a trader at the NGX. Thank you for joining us, Richard.
Thank you for having me. Good morning.
Yeah. So now, are you traders comfortable with the way the market is slowly, it seems as if it's not having much of direction. We can't say if it's bargain hunting, or we can't say, what do you think is happening at the market? What can investors look out for, especially today? Okay.
So, as you rightly said, the market saw a marginal gain in the market yesterday, up by 0.12%. And this was at the back of the gain we saw in MTN, GT Co, and FBN. We're going to see marginal improvement in volume and value, as you mentioned, not to the level that we expect the market to be. We continue to keep eyes on the fixed income side. As you know, that there's correlation between the two markets. And what we are beginning to see, improvement in yield in that market, and that may have a negative impact in the market. As you know, that funds will always try to be channeled towards a market that can give the best return. If you look at the NT bills that happened yesterday, the NTB auction, we saw that there was improvement in the yield of 182 tenor, and though 364 was flat, but we continue to see improvement, and we keep our eyes on that. If you look at the market also, what we are seeing is the retail are the one dominating the market, which is not what we used to see in the market. If you look at the data released from NGS lately, we saw that retail dominate about 70 to 30% of institutional and offshore guys. And this retail, there's little they can do to push the market in the positive direction that we'll be looking at. For us to see the kind of gain, the significant movement, positive movement in the market, we will still go back to what is happening in a FX reserve and exchange rates, because these are things that the offshore guys, the FPI guys look at to come to the market. As you know that, so we begin to see improvement in our FX reserve lately. It's going to see some cushion into the FX reserve, but exchange rate has been an issue that if this can be resolved, we believe that the offshore guys, they might come back to the market and move the market in the direction that we all expect the market to be.
Okay, so now trading is in session today, and yesterday we saw Access Bank, launch its Euro bond, which was oversubscribed. So is this likely to have any impact on the banking sector index of the NGX? And then, of course, what side do you expect the market to close today's trading session?
So looking at the market now, the market is too early to call, as in the market is down as I'm talking to you now, but we're just at the earlier part of the trading section. The market is down by 0.03%. The bonds, the Euro bond raised by Access, and if you look at the rating given to Access Bank, these are positive news to the bank, and this is supposed to rub off on the banking sector as a whole. But because of the level of sell-pressure that we're going to see in the market, that we might not see the impact of that in the company stocks.
Okay. So thank you for that analysis, Richard. So now, like Richard rightly said, before I hand over to Ladi, the fixed income market, bullish performance at the Treasury bills market. Yesterday, the central bank had conducted a primary market auction where it offered about 148 billion naira worth of instruments and then sold 150 billion naira worth of instruments. And then, of course, rates were maintained at 3.5% for the 182-day maturity and the 7.2% for the 364-day instruments. So this was the outcome for the bonds market. No activity at the open market operations, as well as the central bank's special bills. So that's it, Chimizi.
All right, Anita, thank you very much. Okay, we take another break now. When we come back, we do an opening call to London. Okay, let's cross over to London now to get an update on what's happening there this morning. Hello, Juliana, good morning. Well, let's talk corporate news this morning. John Lewis reduced its losses to £29 million in the first half of its financial year. What are the facts behind the figures?
Good morning, Chimize. Pretty strong set of results from John Lewis, the retail juggernaut. This time last year, they were posting losses of £635 million. So to reduce it to just £29 million, which is a reduction of almost 95%, is very good. And I'm sure lots of other retail giants are looking to them for what is likely to be a really prosperous second half of the year. Anybody that's familiar with John Lewis knows that the festive period really is their period. I'm sure right about now their producers are getting ready to produce the pretty famous John Lewis ad. And now that, lockdowns have been lifted, the Prime Minister has indicated that we won't be going back into a lockdown during the autumn-winter period, then it is going to look very good for them. Just yesterday, Chimize, we were talking about a massive recruitment haul from John Lewis. They're going to be recruiting 7,000 staff ahead of what is likely to be a bumper festive season, because we know there are shortages on the shelves, shortages of drivers, so they want to be prepared to try and win back some of that money. In the trading statement, they did also mention £55 million, which was lost due to them closing 8 department stores across the country, as well as offering redundancy packages for thousands of staff.
And tobacco company Philip Morris International has sealed its controversial £1.1 billion takeover of the asthma inhaler maker Vectura. That's after more than half of the target company's shareholders agreed to sell their stock. What more can you tell us about this deal?
Yeah, as you said, it is seen as a pretty controversial deal. Philip Morris International is the maker of Marlboro cigarettes, and Vectura is a pharmaceutical company based in the UK that help people with breathing issues. Lots of their funding is given by government and universities, and cigarette critics have said that, you know, this has taken Vectura in the completely wrong direction, and there are concerns that future funding for Vectura will be stopped or at least paused in the short term, because universities have to make sure they adhere to some rules, and working for a cigarette company isn't one of those rules. But, you know, the deal is signed, sealed. We're just waiting for it to be delivered. As you said, £1.1 billion. 75% of the Vectura board did approve this deal. I believe the threshold is anything above 50. So it's a great day for Philip Morris International. They can see that there is a shift now in the world away from traditional cigarettes to different types of nicotine inhaling methods, and they have pledged that by 2025, so just in 4 years, they'll be making £1 billion from alternative Nicorette products, and they want Vectura to help them do that.
All right, thanks, Juliana. We'll look out for more updates from you later in the day. Okay, let's talk crypto now. Ladi, what do we have there?
Yeah,
green,
we have
red?
Yeah, we have a green actually, and with the bulls actually sitting pretty above 47,000. We have Bitcoin at $48,000, Ethereum over $3,623. Just a couple of altcoins in the red, but it's majorly green. The market cap is at $2.20 trillion. It's up 3.96%. 24-hour volume at 8 a.m. is about $105.23 billion. Bitcoin dominance still at a 41.38%, not going higher or lower. Price of Bitcoin, $48,000 at 8 a.m., up 2.94%. Volume traded in Bitcoin, $32.16 billion. And we have the king of the altcoins there, up a whooping 7% this morning. That's a big move there by Ethereum. 24-hour volume traded, $19.86 billion traded for Ethereum there. Top also market cap, we have BNB, Binance Coin there, $432, is up about 3.55% this morning. And Cardano also looking good this morning compared to this same time yesterday. It's trading at $2.48, at up 4.30%. The only one not doing too good there is was actually Solana there. But XRP is $1.12, up about 3.23% this morning. Top 5 gainers we have Rand there, $1.13, up 30%. And Horizon, that one's been doing well for a couple of days now. It's $106, up about 22%. And we have Sushi Swap also in the top gainers counter, up 19%. Let's bring in Olumide Addition, our financial market analyst. Great to have you, Olumide. Good morning.
Yeah, good morning, Ladi.
Yeah, so I saw a report from Chain Analysis yesterday showing that Africa received $105.6 billion worth of crypto in the first half of this year. What does this tell us?
Yeah, this tells us that Africa is riding on the momentum. This is big, Ladi. If you look at, just like you said, if you look at that volume in percentage terms, that was about over 1,200% year to year. And you need to understand that the key factors are that a lot of young people in Africa, particularly people from Kenya, Nigeria, South Africa, and Tanzania, are moving into the crypto space, despite seeing regulatory constraints in markets like Nigeria, where you understand that the CBN restricted bank transfer. So despite that restriction, people are moving more to P2P. So we are seeing P2P platforms like Paxful, local Bitcoin gaining momentum. And well, if you compare to other countries in terms of transactional size, that doesn't look too big. But the fact that Nigeria is Africa is the third in terms of growth, third fastest in the world, and also we are looking at the fact that the momentum might keep going higher, because this year alone, if you look at the third quarter going forward to the last quarter of this year, the adoption is going at record pace, and that's why we've seen a lot of crypto demographics coming in Africa. So it's not a surprising report, And I did a private research on Twitter, and I found out that most millennials and people from the Gen Z, they hardly invest in Nigerian stock market. They rather prefer crypto exchange, and most of their rationality is behind the fact that the Naira local currency is something. You need to understand that most people get this when you compare the Naira and the dollar, they get it on the black market. It's already over at 560, though at the official channels about 425. Many Nigerians see the opportunity to make arbitrary gains, so they rather go on cryptos, get their earnings in dollars, and convert to local currency. So we are seeing people using it for transactions. We are also seeing it for the fact that people are using to hedge against inflation, and that's why we saw remittance falling in Nigeria by over 22% year to year. So it tells us that people are really losing the traditional financial infrastructure in Africa. They need to do a lot of work because people are, I think, digressing more.
Right. And maybe if it was easier to, trade, Nigerian stocks, or maybe on your phone or something, that would have, attracted more Gen Zs into it, don't you think?
Yeah, but we do have, to be honest, we do have platforms that have quite easy to use interface, because basically I have about 4 trading of these apps, and they're quite decent. But see, that you need to understand that, you see, the profitability in the crypto market far surpasses what you see in Nigerian stocks. For example, if you look at Solana, Solana has given over 300% in less than 30 days. I don't think there's any Nigerian stock that
so it's all about the gains right now, I guess.
Yeah,
all right, Lumide, thank you so much. Always great to talk to you. All right, Chimi there. Look at the top 5 losers. We have Tezos there, down 8%. Hedera Hash Graph for 49 cents. It's down 6%. And IOST and Harmony there. Harmony had a good run from about 12 cents, got to about 19 cents. Was having a pullback there. It's down 3.08%. So, Chimi, the bulls are still quite in control of this market right now.
When you talk about the bull, let me take you back to that discussion with Olumide talking about the gains in the crypto market.
Oh, yes.
Don't forget the risks.
The risks.
Yeah.
The risks are there, because the same way you gain a 30%, the same way you can lose a 30%. So
within a twinkle of an eye.
Yeah.
That's dangerous. I don't think I would want to do that.
Exactly. It's not for the faint-hearted.
Absolutely.
Yeah.
Okay, that's it on the program. Thank you for watching. I'm Chimeze Obi Iwago.
And I'm Ladi Williams. Remember to join us at 1:30 for Business Incorporated. That's the show today. Thank you for watching.